A major bank called Silvergate is now collapsing and voluntarily liquidating all of its assets and shutting down. On November 19th, 2021, the stock hit a peak of $220 per share before collapsing to about $5 a share today. But you know what else hit a peak at that exact same time? This. $59,760. That's the chart of the one and only Bitcoin. And the correlation between Bitcoin and Silvergate Bank is almost identical. Now the question you might have is, what exactly is Silvergate Bank and how come I've never heard of it before watching this video? And the reason you haven't is because it's not the kind of bank that you would keep your money at. Instead, this bank was designed for some of the world's biggest crypto exchanges, which were using something called SEN, the Silvergate Exchange Network. What this was a lightning-fast bridge between crypto assets and dollars so that big-time companies and big-time traders could move their money in and out 24/7. And this system served some of the world's biggest crypto companies, and now it's just going away. So the question is, why is it shutting down and how is this going to impact the entire crypto industry? In 1988, somewhere in La Jolla, California, a small bank was created to originally serve the real estate industry. Now, it was never a massive bank to begin with until it started to grow sometime in 2013 when it shifted its business focus towards the crypto industry. But why would crypto need the help of a bank? Because the banking system is slow, it's expensive, it's closed on weekends, and it uses intermediaries or middlemen to settle their transactions, where crypto was meant to fix all that using the blockchain that's up and running 24/7. But if you want to move massive amounts of money from one place to another and convert it into dollars like an exchange or a trader might, then you need the help of a legacy banking system to hold that cash for you. And you need to hold it somewhere in a bank account, and that acts as the bridge between those two worlds. By 2017, as the crypto industry grew, so did the bank, reaching 250 institutional clients by 2017 and $1.9 billion in assets. Fast forward to 2019, and Silvergate goes public under ticker symbol SI. The stock price was just $13 per share. By the end of 2021, the bank had grown to roughly $14.3 billion on deposit, and their share price was up over 1,500%. Fast forward to today though, and that stock has lost over 90% from the peak, and they're shutting their business down. Now in the world of banking, $14.3 billion, which was Silvergate's peak, is tiny in comparison to commercial banks, which have trillions of dollars on deposit. So if that's the case, then why does it matter that such a tiny crypto bank is going out of business, and why would it affect anything? But in order to tie all this together, I want to explain exactly what they did and where it all went wrong. In a normal bank account, like a savings account you have right now, for every $1,000 you deposit, you're making about $2.30 per year on it. And that's because the national average APY for a savings account is only 0.23%. Now, even though you know that you're getting very little, and you know full well that right now you could find about half a dozen banks that are going to pay you way more, you're still probably going to stay right where you are because it's convenient and you pay all of your bills through there. This means that your money is very sticky, and banks understand this concept of stickiness. Now, even though they know this though, they are still required to follow what's called the LCR. This is called the liquidity coverage ratio. This means that a bank has to hold at least 30 days worth of cash outflows in high quality liquid assets. JP Morgan, for example, in 2022 had $2.3 trillion in deposits, and they held about $733 billion in those high quality assets, the majority of which were in treasuries and other types of government bonds earning interest. That is the legacy banking system using dollars. It's a slow and controlled system that takes into account the fact that the average person doesn't need to move their money around 24/7 at lightning speeds, but crypto does. So let this be a learning lesson for what happened for all centralized finance companies. But first, a quick word from today's sponsor. All right, so a lot of traders like to use technical data to figure out which stocks they want to buy. Now, that is a skill and a talent that I never had because identifying those trends and which stocks will benefit from them is really hard to do. But with today's sponsor, Moomoo, it might just be possible. And that's because Moomoo allows investors to see every step of a company's supply chain so investors can find new and fresh investment prospects. So for example, the EV industry's supply chain details for every phase, from raw materials to charging networks, you'll be able to see exactly what's going on. Now, even though I'm personally a boring broad market index fund investor, Moomoo's paper trading app offers a realistic, simulated environment so you can test your strategies before investing. So if you ever want to learn how to trade, Moomoo's a great platform to try that with. The app also covers some of the hottest traded markets, including the US, Hong Kong, Singapore, and China Type A shares. They have real-time quotes and data, and they give you access to professional level tools, including new charts and indicators to help you shape your approach regardless whether you're aggressive or conservative. But the best part is that new Moomoo users from the US can receive up to 17 free stocks when signing up. Australia users can receive up to 10 free stocks if you use the link in the description below the video before March 31st. Moomoo is also regulated by the SEC, and they have SIPC insurance coverage as well. So give them a try, let me know how you like them, and now let's get back to it. So remember, big banks and dollars move extremely slow, and that money's extremely sticky. Crypto is the exact opposite, because it's the crypto company that offers the highest APY that week that gets the most amount of deposits, and because a lot of transactions are done on smartphones, everything's extremely fast. So money is the opposite of sticky inside of crypto. That's where Silvergate made their first bad assumption. Remember how big banks need to use the LCR, the liquidity coverage ratio, to cover at least 30 days of stressed withdrawals by parking their money into high-quality liquid assets? Well, Silvergate Bank had only 11% of its deposits inside of that high-quality asset. It was just cash, but they needed way more. Not only that, but it turns out Silvergate Bank was not big enough to even have to follow the liquidity coverage ratio, and this is where they made a huge mistake. Most of the money they invested was put into mortgage-backed bonds with a 10-year maturity rate. Now, those bonds were not meant to be sold before maturity, because if you try to do that, you might get less for your bond than what you paid for it. And guess what happened to bond prices? They've been falling like crazy. Take a look at any bond prices and you can see exactly that. And the reason they've been falling is because our main man, Papa Jerome Powell, has been increasing what's called the federal funds rate. And anytime interest rates go up, bond prices will fall. That's because when new bonds are created, they're created with the newer, higher interest rate. But the older bonds that people bought before have that lower interest rate. So if I'm an investor, why would I pay more for a bond that's paying me less? I'm gonna offer less for that older bond because I'd rather get the newer, shinier bond. That's how, when interest rates go up, bond prices fall. And because 82% of Silvergate Bank's deposits were crypto-based, they were forced to sell those bonds at a loss to meet those withdrawal demands. And that's when it all started to collapse, when FTX and other centralized exchanges started to become insolvent and people wanted to withdraw their money. But looking back at the data, crypto exposure is so unevenly distributed in the banking system that it was only one bank that had the majority of exposure to it. According to biz.org, Silvergate Bank had 61.7% of the exposure, which is more than the next 4 banks combined. Silvergate lost roughly $8 billion in customer deposits thanks to the bank run, at which point they borrowed $4.3 billion from the FHL bank system, which was only supposed to be used by members of the FDIC, which they were, to help with primarily low-cost mortgages and liquidity. This upset a lot of regulators because here we had a crypto company that was using FDIC insurance money to save itself. But this should be a wake-up call to regulators that if you force crypto companies to become FDIC members, then you shouldn't be upset at them when they're playing by the rules and using that money to bail themselves out. Now, thankfully, since they borrowed that money from the FHL bank system, they've been able to fully repay back their loan. But this will force crypto companies to now use a different bridge, which means they'll most likely resort to using stablecoins, but that in and of itself has huge risks attached to it as well. I'll save that for another video, but surprisingly, Bitcoin is held relatively stable throughout all of this. But the lesson here is this: crypto in its current form, without protections and without frameworks, is like an unstable chemical reaction that is waiting to inevitably happen the moment you combine it with the traditional banking system. The moment you treat a crypto bank the same as a normal bank is the moment that things will go down. And that's because not only crypto is not as sticky as it's supposed to be, but also because you're not supposed to create loans and investment-grade products using such a volatile asset as collateral. And because Bitcoin was not meant to integrate with the fractional reserve banking system because dollars are stretchy. The supply can be contracted and expanded, but Bitcoins can't. So the next time you see a crypto bank that is actually regulated or maybe FDIC protected, please remember that that is still a very big risk and you should still be very careful. On the Voyager side of things, a quick update, there was a huge victory over the SEC because a bankruptcy judge ruled in favor of Binance's acquisition of Voyager, which means we could recover up to 73% of our funds. Now, this would be incredible, unless of course FTX and Alameda win their $446 million lawsuit, in which case this number goes down to 48%, but in my opinion, both of those scenarios would be amazing. Stay tuned, I'll update you as soon as I learn more, but in the meantime, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below. Go track them automatically with the spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. Stay safe, bye-bye.